This year has been a good one for stock market investors, but 2018 is likely to be trickier. Well, that's the warning from the investment bank Morgan Stanley, which has today published its 2018 outlook. And it is particularly cautious about the UK market. Well, here to tell me more about that is Graham Secker. He's Chief European Equity Strategist at Morgan Stanley. So, Graham, good evening to you.
Evening.
So, you're positing a rise of just 5% for the FTSE next year. Why is that?
Well, markets have had a very strong run over the course of the last 12 to 18 months. And also it's occurred with very low volatility. And as we go forward, we think there are a number of things that are beginning to change at the margin. So the economic environment slows moderately. The uncertainty that we have had for some months continues into next year. But overall, it's not just the UK. We actually have global equity markets coming under pressure as we move through 2018. There's a number of things that have supported markets over the last few years that at the margin are just beginning to lose a little bit of steam.
Chiefly, of course, ultra-cheap money. We've got the Fed raising interest rates, Bank of England tightening, BOJ even maybe.
Yes, and I'd add the ECB to that as well. So all of the central banks over the last few years have been running extremely easy monetary policy, which has meant asset prices go up everywhere and across all asset classes. But as they start to just take that money back a little bit, it's supported this momentum, and therefore as you bring it back you would expect some of that momentum to slow down as well.
But you also think there's going to be added volatility in credit markets?
Yes, if you look, so we think credit's been the biggest beneficiary of all this money that's been printed by these central banks. So as they start to take that away, it's a natural place where you'll start to see some cracks emerging, particularly in the US actually, when US companies have taken on this free money and basically issued a lot of debt, bought back their shares. So their leverage ratios are very high, or their balance sheets now look extremely stretched relative to any point over the last 10 to 20 years.
Very interestingly, in your comments on the UK stock market today, you said that the political situation in the UK is at least as important as Brexit.
I think so. It depends whether you want to focus on the economy or you want to focus on your job as an investor. For the economy, you would say your main focus is on Brexit, and that has the greatest potential to impact the economy and slow it down as we go forward over the course of the next 12 to 18 months. However, our point is that if you're actually a UK fund manager looking to invest in companies, it's the combination of the Brexit uncertainty coupled with the domestic political uncertainty in terms of which political party over the next 1 to 2 years will be sitting in number 10, and the policies that they put forward. And it can have quite a radical change in the backdrop, something we haven't seen for perhaps 30, 40 years.
Well, quite talk of nationalisation and so forth.
Yeah, I mean, that's probably at the extreme end of things, but it's not something you can categorically rule out. So there's a number of what the market will probably perceive initially to be business unfriendly policies that could come through. And it's, you've had a very clear trajectory for many, many years into moving forwards to a fairly business friendly, capital friendly environment, and that we may start to embark on a different trajectory. And I think that scares fund managers, because the thing that they like least, as we know, is uncertainty.
All right, Graham Secker from Morgan Stanley. Great to see you. Thanks for joining me.
Thanks.